What an incredible week. What an incredible month. Your report update followed by this week's update only tells me that there is more positive momentum ahead. Really crazy stuff. I don't think anyone ever saw this. I don't even think the T0 team necessarily saw this coming from the overstock dividend, but it's clearly been a whirling success. And to your point, liquidity, folks, the question, the mystery around security tokens. Is it there? Is it real? Well, clearly, based on what Kyle has just told us, it is. And with that, I think we can get right into the main topic.
Yeah, I think that I can't wait for it. I'm sure our listeners are waiting at the bit just to hear the main topic. And so let's dig right into it. Our topic today is one of those benefits that did not exist before the advent of security tokens. And so we're talking about self-custodied investments. You see, in both public and private markets, your investment is never really self-custodied in the sense that someone else always controls the ownership of your investment. It's usually your brokerage firm or wealth manager. The idea that the investment could be represented in a digital token format and therefore traded and managed by your own control is a 0-to-1 shift, which is a change in the entire mentality of equity ownership.
I totally agree with you, Kyle. I think this is one of those benefits that was quantified by the ICO era, actually. Back then, anyone participating actually had to custody their investments or purchases if you don't want to fess up and call them securities. But regardless, this created a risk in crypto, of course, because if someone hacked you and stole your tokens, you lost your asset for good. As we discussed in the main topic of episode 13, custody for security tokens is a different animal, though, and represents zero risk of hacking. By design, the legal ownership is linked to an individual, and the token ownership cannot be transferred without the registry being updated, and smart contracts are in place to ensure all the parties that are involved have their identity known. Furthermore, there is simply a ledger, and by the power of the issuer, the ledger can be overruled. So security tokens can be placed back into the correct holder's hands, right, in case someone were to have had theirs transferred illegally.
It's worth mentioning also that this transaction would of course be recorded on that immutable ledger, so the issuers themselves could never pull something malevolent on the investor without the permanent record of such action, in which case the individual would have pretty clear evidence in any legal recourse.
Yeah, I would say so. In fact, all in all, I think security tokens make the process of custody digital and better and trustless thanks to the blockchain, right, Kyle? So look at it like custody 2.0. And the biggest thing that comes with custody 2.0 is the feature of self-custody. So let's break that down for our listeners, what this actually means and how this can be useful.
That's what we do best, Herwig, so let's get right into it. Beyond the benefit of a trustless ledger giving you the legal protection for your ownership interests like we just mentioned, the other main clear value proposition is definitely in the peer-to-peer transfer capabilities, which gives individual investors the ability to create liquidity for their own assets. The big issue for private markets before security tokens is the long period where you don't see a return on your investment until a liquidity event through an IPO or a sale of the company. In the traditional financial world, that's pretty much the only realistic way you could realize returns on your investment. Don't get me wrong, secondary markets for private markets do exist. They just happen to be extremely cumbersome, and the process of selling your interest stake goes beyond just the legal challenges, also including technical and operational hurdles. Technical in the sense that each transaction is typically unique, requiring new attorneys and new documents to be written up every time a transfer occurs, and operational in the sense that you may need to seek board approval or many other requirements because of the documents that were not structured properly for resale. Both of these factors add to the difficulty and impracticality of secondary transfers on a large scale in private markets. All of these issues are thrown out when you use a security token because there's one universal ledger and it's used for the software updates, and the ownership and compliance are automatically recorded, automatically updated using the technological standards of which are interfaced through the security token.
Well said, Kyle. Essentially by digitizing the company's equity, the ability to do a secondary or peer-to-peer transaction becomes dramatically easier because the company doesn't need to be involved in the transaction itself.
Exactly. Self-custody, if you will.
Right. So that is definitely a game changer. Liquidity is always described as one of the hallmarks of security tokens, and we may not have active exchange volumes like the public markets for security tokens, but security tokens do enable direct transactions from day one after the lockup expiration, of course. This is major because most private securities never traded in the first place, and now they can. That's a really, really big deal. That's a new form of liquidity never seen before for private securities. Unfortunately, no security token can get to exchange or secondary market level liquidity, though, without needing one of those two involved.
It's also important to explain why there, Herwig. So some really hot companies like Airbnb or Coinbase might have a big enough reach that they could form a private market that would definitely support the same levels of liquidity thanks to blockchain technology. The problem isn't technical there, though, but legal, as we discussed this very issue in last week's episode about Section 12G of the Exchange Act, which specifically limits private companies from having more than 2,000 individual shareholders before they need to register as a public company with the SEC.
Yeah, you got to check that episode out. It's an important one for security tokens. All our main topic clips from all our episodes are available on YouTube if you didn't know that. And yes, Kyle, Section 12G does prevent an issuer from really growing to the big boy leagues of liquidity. You'll need an ATS or exchange to get involved at that point to help manage your investors and let you scale beyond that 2,000 investor number.
Still, self-custody is a big deal because not every private investment needs that secondary market liquidity right away. Because its value is not big enough or because it doesn't have a large enough audience or whatever the reason might be. The benefits of peer-to-peer trading thanks to self-custody are immense, maybe the biggest benefit that you can get because of that individuality and the ability to do whatever you'd like. What other benefits of self-custody do you think are also important, Herwig?
Well, I think it's important to also highlight how big of a deal it is for an investor to have the ability to really move their investment from one market to another, right? The way I see it is once you take ownership or self-custody of a security token because the issuer has released it to you or you bought it from someone or on the market, then you now have freedom, everyone. That freedom to manage your security token however you like. The freedom to move from one exchange to another because maybe there's a better price there, or to move it off of an exchange in order to perform your own peer-to-peer transaction or even gift it to somebody directly. All now possible thanks to self-custody. All of these things could be done instantly and entirely digital, which is just the real game changer for private markets, which were completely analog and make all of these benefits impossible without a security token.
Freedom is a great word for it. The freedom to control our investment thanks to self-custody. So I think that just about sums it up. What do you think?
I hope we explain the benefits of self-custody using, security tokens very clearly, but you tell us, listeners. We want to hear your feedback, comments, and questions. We're reachable via Twitter or LinkedIn, and you can always engage directly with the entire community, even submit your own articles, as Kyle mentioned, all at stomarket.com/news. And with that, our show comes to an end. I want to thank you all for listening and look forward to catching you all next week.
Thanks for listening.